Assalamu alaikum wa rahmatullahi wa barakatuh, and welcome to everyone to this fifth session of the Islamic Business Masterclass. We also welcome our audience from the public who have joined us for this first presentation on Murabaha Trade Finance, where we have esteemed speakers of Albaraka Bank to give us an overview of the Murabaha Trade Finance product and how it can be used by Muslim businessmen who are seeking to finance the acquisition of trade goods in a permissible manner. So we welcome our two esteemed speakers, and we will be commencing with their presentations in the next 2 minutes or so. Just as an introduction to those who are joining us for the first time via YouTube Live, Dean Pro is a fairly new organization, about 2 years old, and our objective is to encourage the integration of Islamic knowledge, the application of Islamic law into modern business practice. And we have introduced the Islamic Business Masterclass as our flagship program for 2022. Alhamdulillah, we have a good number of participants who have been through different modules already, including Islamic contract law, the law of sale, the law of leasing, the laws relating to partnerships, and we still have much to cover in the next few months. This is a closed course which commenced in May and will continue until December. But Alhamdulillah, it will be rerun in future years, and you can follow us on social media and get in touch with us via WhatsApp as well, the details of which are available on our social media pages, and you will be able to pick up when we will be commencing the next round of the Islamic Business Masterclass. So without further ado, I'd like to welcome firstly Mr. Reyaz Karodia, who is the regional manager for SME, small and medium enterprises in the KZN region for Albaraka Bank. We welcome him and request him to commence with his presentation on Murabaha Trade Finance. Reyaz, over to you.
Jazakallah for that, Maulana. I appreciate that introduction, but I think the more esteemed colleague will be after me. Assalamu alaikum to the listeners on the program. As Maulana said, that I'm the KZN SME manager, and inshallah we'll just enlighten people on the Murabaha Trade Finance for this morning. Just at Albaraka, in the last, maybe COVID was the catalyst for this, but I think it's been something that was coming. One of our strategic objectives has been digital innovation. And to that effect, I think we've seen drastic steps made on this front, the highlights of which we're looking at the launching of our business and our mobile app for both business banking and personal banking. That was launched last year. And very recently, we've also in the process, we've launched the signing of legal agreements. So the bank's legal agreements can be signed online. So there's no longer the need for killing of forests and that. We can do this online. And it's been only launched probably 2 months ago, and it's been working very well. The bank caters for everybody in terms of individuals, businesses. We've got a complete suite of products that can cater for all the needs of the consumer. Just to touch on some of the products, in terms of your Islamic banking products, we've got transactional banking, investments, wealth for individuals. The wealth side caters for people who are looking for retirement products as well. So people from now, if you are looking to retire when you get to the age of 55 or 65, now is the time. It's never too early to start saving for your retirement. And on the business side, we've got transactional banking as well for all business accounts with full internet banking, and the financing, various financing options in terms of whether it's fleet finance, asset finance, commercial property, development property. So there's basically everything. We can cater for every single need, banking need of a client. Just one product I also like to highlight is the attorney trust saver. This attorney trust saver allows clients to invest, or attorneys to invest money with us and get a Sharia compliant return on behalf of their clients. The main focus of today is going to be on the trade finance. Mona has asked me to talk about our trade finance product. And you can go to our website. The website has information on the trade finance. So please feel free to go through it, browse the website, and find out whatever is it that you need. But for now, I'm just going to try to give you just a little bit of information on the product, and maybe inshallah we can take questions at the end of the session. So a trade finance, as you know, the cash flow is the lifeblood of any business, all right? And I know it's a very simple description. Most of you obviously know this, but just to understand where a trade facility can benefit a business. In a typical business, you have the sale made, customer pays you, whether he's paying you in terms or he's paying you cash, money in your bank account, you pay your supplier, and we continue with this process. And in a perfect world, it works, everything works smoothly and there's no problem. But I think we all know the real world is a bit different in that you have to pay your supplier, but your customer is not always paying you immediately. So that creates a gap in terms of your cash flow. And that's where a Murabaha trade facility comes in. In the conventional sense, people will use an overdraft. But from a Sharia perspective, we will use a trade facility. So just to give you an idea, in terms of which businesses can use a trade facility, so it's across the board, right? Whether you're a retailer, you're a wholesaler, manufacturer, importer, exporter, it doesn't matter which industry you're in, all these industries, everybody can use a trade facility, because at the end of the day, it's all about bridging that cash flow gap. So why a trade facility? What is the benefit, or what is the advantages of a trade facility? Firstly, it's enhanced cash flow. If I had to go to the previous slide, we spoke about the fact that customers may not be paying you immediately, whereas you need to pay your suppliers. So the trade facility bridges this gap in terms of you receiving your cash and paying your cash. So already that's a big advantage for any business, right? I think most businessmen would attest to the fact that that is one of the major issues and the major things that keep them up at night is cash flow. In terms of growth opportunities, so for example, if you have more cash flow, it means that you can buy more stock, and therefore you have more to offer your clients. So that's natural. That's a very simple advantage of a trade facility. Flexibility, we'll talk about in the next slide. It's simply that you have flexible terms in terms of repaying the trade facility. So again, that aids your cash flow, and depending on the type of goods that you're selling and the speed at which you collect your funds, that's where the flexibility comes in. In terms of financial discipline, I think this is a very important thing. Many people use overdrafts, and the problem with the overdraft is that it can be used to pay for anything, whereas your trade facility is specific for goods being purchased. So, and this doesn't apply to everybody, but some people, if they have the facility available, will use it to pay for a holiday, to pay for a car that they probably didn't need, or a more expensive car that they didn't need. And that creates that could have cash flow implications at a later stage. Whereas with the trade facility, it's simply you buying goods that you know will be for resale or for production, and that will add to the income of the business. So it's income generating. So I think that's a great advantage in terms of the trade facility. All right. From a goods perspective, the type of goods, obviously from a Sharia perspective, all goods have to be compliant, right? So we won't finance alcohol, we won't finance haram meat, for example. Other than those, the few items that are not, cigarettes also would fall under that category where we wouldn't finance cigarettes. But other than that, we will finance almost any other product, as I said, as long as it's Sharia compliant. And it's goods for resale. So for example, if you are a wholesaler or you are a retailer, we would finance that. Also, very importantly, it's used for raw materials. It can be used for raw materials. So those of us who are in manufacturing, the facility is available to purchase your raw materials and obviously create the finished product. We offer both the local and imported offerings. So for example, you are importing goods from China, India, wherever it is, we have a facility for you. Your facility can be utilized to purchase goods from those countries. And on the local side, from your local suppliers, normal payments. So if you have a facility in place, it can be used for both. It's not specific. The facility is not specific for local or imported goods. It can be used for both products or for both suppliers. I think just some of the features of the trade facility. Once a facility has been approved, you would request us to make a payment to your supplier based on an invoice, because Maulana will go through the details in terms of the practicality, in terms of the Sharia aspect. But the basic premise is that we are buying the goods and selling it to you, right? So when you're purchasing goods from your supplier, you will send us the payment request and we will make a payment to your supplier. There's no deposit required from your side. So we can finance the full purchase price of the goods as long as it falls within your facility. As I alluded to earlier, the flexible terms, different goods sell at different speeds. And also the collection of funds takes place at a different speed as well. So from a facility perspective, there's a maximum term of 270 days that we offer for imported goods and 180 days for local goods. The reason for the difference in terms of the period is just because your import cycle is a bit longer. From the time of placing an order to actually receiving the goods could take anything between 2 to 4 months at times with imported goods, whereas generally with local purchases, it's a lot quicker and your goods arrive much sooner. So that's the reason for having a slightly shorter term. Just on imported goods, very often suppliers ask for a deposit upfront. So we can make that payment to your supplier. So again, that it allows you to use your cash for other resources and that for your business, whereas we will pay the supplier. And while you're waiting for the goods, none of your cash is tied up. The terms of, as I said, it's flexible. You can even split the terms. You can go 30, 60, 90, 120 days. You may decide that, listen, these type of goods, I might want to stockpile, I want to sit with them. So I might only sell them in 6 months. You could rather do one repayment after 6 months. And that's where the flexibility comes, which I think is very important. Pricing wise, it's very competitive. The product ranges from probably from about 0.8% a month to about 1.5% a month in terms of the cost on your invoice. So for example, an invoice, the maximum, say on 100,000 Rand, would be 101,000 Rand in terms of if you had to take it for 1 month. So it's pretty much very competitive. And I think we've seen many businesses take advantage of this product because of the competitive pricing and the flexible terms that are involved. Many suppliers locally offer cash discounts, and the facility can be used to pay those suppliers. So from a supplier perspective, he's receiving his money immediately. So he can give you a cash discount, and if you're getting a 2 to 5% cash discount and then taking terms with the bank, you still could be saving money, and at the same time you're getting the extended terms. So we see many clients who do that and have made substantial savings in their purchases. As I spoke earlier in terms of the flexible, the deposit required was that there's no tie-up of your cash. When you are importing, we pay for the goods until the goods arrive. You do not make any repayments. So your repayments will only start once the goods arrive, once you are in a position to start selling the goods, once you are in a position to start manufacturing. So in that time that the goods are still being shipped, and that there's no cash flow burden on your business. Freight and clearing charges, this can be included on each invoice. As long as it's specific to that invoice, you can include that. Purchasing additional stock prior to price increase. So we know that certain industries from time to time expect a price increase at certain dates. And what we found is that many of our clients would buy substantially extra goods before the price increase to take advantage of that lower price. And in that way, benefit from the lower prices. So that's a very big advantage to many of our customers. The other thing is that the trade facility can also be used in conjunction with existing terms. So many businesses will be getting terms, maybe 30 days, 60 days from their suppliers. And we do something which is it's called diarized payments. So you would tell us to listen, make a payment in 30 days. So I'm taking delivery of the goods today, but only make payment after 30 days. So you get that 30 days from your supplier, and then you will take the additional terms from the bank. So meaning that you could take 30 plus another 180 days on a local purchase, which will give you 210 days, which will give you a longer period and obviously ease your cash flow burden. In terms of getting the facility approved, I think we've gone through the benefits and the reasons why a facility could work for you. In order to get a facility approved, it's the information that we'll require is your basic information that most of you would be already getting. The FICA, which you would have, your latest financial statements, which your accountants would provide, your 3 months bank statements, management accounts, again, which your accountant would provide, the personal assets and liability statements of the directors and shareholders. And in cases, we would also require your creditors and debtors age analysis. One of the important requirements from Albaraka's side is that we ask for collateral. And in most cases, clients, they give us their properties. So we will take a bond over their property rather. We don't, depending on the level of security required. Also, there's certain clients who give us investments. They may have unit trust and other investments, maybe even with other banks as well, that they may be willing to give us as security. And generally, I would say from my experience, I'd say that 90% of the clients give us those two as collateral. The level of collateral generally depends on the strength of your financials. So when we're looking at granting facilities, we look at the strength of the financials, which is very important. The credit profile of a client, obviously there mustn't be any negative issues on their credit profile and that. and their security that they're willing to provide. Based on those three factors, we would approve a facility. And for more information, as I said, please go through to our website, but also you can contact us, myself in the KZN region, and there's various consultants in the KZN region, and also in other regions as well. You could find consultants, and we'll come and see you, visit you, and discuss your requirements and what's the best facility that we can put in place for you. Jazakallah for that. So I hand you over to Maulana Safwan again.
Jazakallah Reyaz for that good overview of the Murabaha product. We're now going to go to Maulana Musa Zuma, who is the Sharia Advisory Manager at Albaraka, and Maulana is going to be covering the Sharia aspects, the Sharia constructs and processes that form part of a Murabaha trade finance product and the facility, and that would give our attendees a good understanding of how different a Murabaha trade finance facility is from any conventional interest-bearing overdraft and so forth. So with that, over to Maulana Musa. Maulana, you're on mute.
Assalamu alaikum and good morning to everyone. In this session, I will basically cover Murabaha trade finance from a Sharia perspective. But before I get to that, I would like to start with two key principles of Islamic finance, which basically talk to the main difference between an interest-bearing loan and Murabaha finance, or Murabaha as a financial instrument. And at the end, I will basically conclude with the economic benefits of Islamic modes of finance, and that will basically follow from my discussion or my explanation of the two principles of Islamic finance. The first one being sorry, I'm having a bit of a problem. My slides are not moving. Okay, so the first principle being that that money is not a commodity, meaning that in Islam you cannot exchange 1 rand at a premium or at a discount. So this particular principle basically forms the basis for the difference between Islamic finance and conventional finance in many ways. So in conventional economics, money is deemed to be a store of value, albeit not perfect, because in the event of an economic or political or social instability, the value of money or the value of the currency can go to zero, sometimes in a matter of days. And this is because money, unlike gold or silver or any other form of durable asset, does not have an intrinsic value of its own. And money is also or deemed to be, or is basically a unit of account, a medium of exchange and a financial asset, which in conventional economics can be loaned and get money in the form of interest. The justification for money begetting money in conventional economics is that 1 rand today is better than one rand tomorrow. So if I lend you 1 rand today to repay tomorrow, I have to defer consumption today for tomorrow. And for that reason, the theory goes that I deserve to be compensated for the sacrifice that I've made, and the compensation is in the form of interest income, which basically is calculated as a function of time and the probability of default, and that's how it's done normally in conventional banking, particularly. The Islamic concept of money is slightly different in that in that money is regarded to be a store of value, a unit of account, a medium of exchange, and also a financial asset. But money in Islam shall not beget money. And why? Because the only way money can beget money in an Islamic economy is through investment in the real sector of the economy. So if you invest money in the real sector, and the reason why, or the rationale for this, is because if you invest money in the real sector, there's no guarantee that you will make a gain. And based on that, or based on that fact, lending money on interest is deemed to be an unjustifiable means of enrichment. But this is not the end of the story. The other reason is that if you are blessed with large sums of money, you and your offsprings can remain rich forever by simply loaning that money and live off the interest income. This particular practice results in the current socio-economic structure where the rich get richer and the poor get poorer. For the poor to catch up, they need to risk the money that they have borrowed by investing it in the real sector, and often they make a loss. So prohibiting interest in Islam is a way to basically level the playing field, so to speak, so that the only way the rich can get richer is by investing their money in the real sector of the economy and take direct exposure to the business risk. If the business succeeds, the investor will make more money, but in that process, the investment will create jobs, and which will basically make the poor better off, and in that way reduce income disparities in society. The other factor or reason why interest is prohibited is that if money can beget money, governments can simply print money, lend to banks, and if that happens, it will result in an increase in the money supply in the economy, which is not consistent with the increase in the country's economic productivity or GDP. And when this happens, you end up with a situation where you have a lot of money chasing a few goods, and resulting in a rise in the price of goods and services, such that the money that the people have accumulated, or the money that people have in their pockets, now buy fewer goods And when that happens, there's suffering that follows, particularly for the poor. We are currently in this kind of situation globally, and the only way to resolve or to solve this problem is to increase the market interest rates so that people borrow less and the demand for goods and services decrease and prices stabilize. But in that process, recession sets in, companies stop hiring and others downsize. So the reverse process also is painful because those who have borrowed money when interest rates were lower cannot afford to service those loans now at a higher interest rates. And that results in consumers losing their precious assets, cars, homes, you name it, and businesses basically going bankrupt. So in Islam, an interest-bearing transaction is defined as a contract whereby the borrower agrees to repay the principal amount plus an additional amount in lieu of the opportunity cost of funds. This particular definition is critical because if you borrowed money on the basis that you will repay the lender the same amount at a certain date or when you have the money, but then you repay the lender principal plus an additional amount as a gift, it is fine, from a Sharia perspective because it was not contractually pre-agreed. And the one question that follows from this concept of money, the one question that follows from that is why exchanging $1 for 17 rands okay or permissible in Islam if one cannot exchange 1 rand at a premium or discount. So earlier on, we said that money is a store of value, but the question is, how does money derive and store value? Money basically derives and store value from the economic activities that take place in the economy when people exchange goods and services using money as a unit of account. So Islamic law allows the exchange of currencies of different denominations at premium or discount because of the law of one price and the difference in the purchasing power of the different currencies. The differential in the exchange rate is meant to basically restore parity in terms of the law of one price, and the law of one price simply states that transaction costs aside, it states that the price of identical goods or identical goods in two countries should be the same when expressed in terms of one currency. And the second principle that I want to speak about, which I've to some extent already covered when discussing the first principle, is the principle that the only way, because interest is prohibited in Islam, the only way to make money is by investing that money in the real sector of the economy. And this principle, and as well as the previous principle, basically they are basically premised on in the Quran 275, the verse of the Quran, which states that they say refers to the Arabs or the non-Muslims at the time when the Prophet ﷺ was still alive and was busy, propagating and teaching Islam. They used to say that dealing in interest was the same as dealing in trade. And Allah subhanahu wa ta'ala responded by saying that He has allowed trade and He has prohibited interest. And the reason why, or rather the benefits of this, I've already explained. But other than that, by investing in the real state of the economy through trade or equity investments, Islamic law ensures that the funds are directed to the most productive assets. And why and how? And because the owners of capital have direct interest in the underlying assets or the underlying commercial activities. So what happens normally with a conventional bank is that when you go to a bank and you want to borrow money, and you can prove that you have the means to repay the money, they will lend you the money irrespective of how that money will be utilized. In the case of Islamic finance, because Islamic finance is asset-based, and the financier or the investor has a direct interest in that particular asset, will make sure that that particular investment will generate the expected rate of return, and will make sure that that asset is a productive asset. So from an Islamic perspective, in short, a productive asset is an asset that is not in many ways prohibited. In other words, Islamic banks will not provide finance for acquisitions of assets that will be used for impermissible purposes. And by doing so, Islamic economics or Islamic law promotes the expansion of the real sector of the economy, and it prevents over indebtedness and in many ways, corporate failure. So the question is that what's the difference between a loan, and I think this is the question that most people ask, our clients ask, what is the difference between taking a loan at a conventional bank and coming to Albaraka and do a Murabaha finance transaction? So basically, when you go to a bank, obviously these days you make an application maybe in person or online, and the bank will vet that application just to make sure that you are creditworthy. In other words, you have the means to repay that money, and the bank will give you the money if you qualify for finance, and the only requirement is for you to repay principal plus interest over the agreed finance term, right? So because there's no underlying economic activity generating income for you to be able to to pay back the principal amount plus interest to the bank, the act of paying interest to the bank is deemed to be an unjustifiable means of enrichment and therefore prohibited in Islam. Now, the question is, what's Murabaha, right? So basically, Murabaha is a contract where the purchaser agrees to buy goods from a seller at cost plus. There are reasons why a person might want to buy goods on the basis of Murabaha, as opposed to just buying goods just like that. So in the case of Murabaha, in Islamic law, there's a requirement that the seller disclose the acquisition cost of goods. So this particular requirement comes handy when the purchaser does not know the value of the goods, right? So this happens many times when the goods are import or they are bought from other cities and you don't know what the value of the goods are. So in order to prevent people from being ripped off, so there's a requirement that you must disclose what it costs you to buy those goods and transport those goods to the current location, right? And then on top of that, you can add your profit markup, and that profit markup obviously will be negotiable between you and the purchaser. So in that way, it makes this particular price, a fair price for those goods. And to the extent that in Islamic law, if the seller was dishonest in disclosing the cost, the acquisition cost of goods, if he overstated the cost, then the purchaser has recourse to the seller for the excess. So you can take him to court and sue him and recover the excess. Islamic banks use Murabaha as a financial product simply by allowing the client to pay the purchase price in installments over a pre-agreed finance term, right? So this is the one feature of Murabaha that that makes it attractive for financial institutions, because it's a very, very simple kind of instrument in a way, in the sense that the only thing that you need to do is basically allow the client to repay the purchase price over time, as agreed between the bank and the client. But the one of the key differences between a loan and Murabaha is that in the case of Murabaha, the price remains fixed for the duration of the finance term, to the extent that even if the client defaults or the client, whatever, or the client wants to restructure the deal, he wants the term to be extended because he cannot afford the current installment, the price and the installment may be reduced, but the total price will remain the same. It won't change. And the other element, the one question that people ask is, okay, so you're saying that Murabaha is different from a loan, because in the case of a loan, a bank lends you money. In the case of Murabaha, the bank will buy an asset and sell it to you at cost price. But when I do, when I calculate the implicit finance rate in the case of Murabaha, that finance rate, approximates the rate that I would have, paid if I borrowed money from a conventional bank. So the question is, why is this the case, right? So the main reason is that Islamic financial institutions, they operate in an integrated financial system, and the Islamic financial products are good substitutes for similar conventional financial products. And Islamic banks cater for everybody, irrespective of whether you're a Muslim or not. So the forces of supply and demand basically drive, Islamic, prices or pricing, whatever the case may be, to approximate the pricing for similar instruments or for similar conventional banking or financial instruments. And the other reason why this is the case is because on the other side of the equation, the bank basically takes deposits from the clients on the basis that the bank will take that money and invest it and generate an income for the depositors. And depositors expect a competitive rate of return on those funds. So if the bank cannot generate a competitive rate of return, the clients will basically take the money elsewhere. The bank will, experience deposit flight, and the bank will eventually go under. The other element is that the bank also relies on shareholders' funds, to fund its operations. And the shareholders also, they have their own expectations. They want the bank to be able to generate a competitive rate of return on equity. If the bank cannot do that, then the shareholders also will pull their money out of the bank, or they will not provide, further funding. And that also can result in the bank, collapsing, somewhere down the line. Now, the other element is that Islamic banks take some kind of security to protect the interests of the shareholders, of the stakeholders, in particular depositors and shareholders, in the event that the client default, on his payment obligations. And the reason is obvious because if the bank, firstly, if the bank wasn't worried about whether the client is credit-worthy or whether the asset that the client is financing or the project that the bank is financing, it's a good project, right? So it would lead to a situation where most of the clients would default, and if most of the clients default, then the bank will not be the business of the bank will not be sustainable. Okay, so the question is how the mechanics, how does Murabaha finance work in practice? So in practice, there are various steps that that are taken in order to make sure that each Murabaha finance transaction is consistent with applicable Sharia principles. So the way it works is that normally the client will come to the bank and the client will make an application for Murabaha trade finance. And the bank obviously will vet that application to make sure that it's a good business proposition, or the client is credit-worthy, or the business of the client is credit-worthy. And once the bank is satisfied with the client's position or the client's business position, the bank will approve the application and then appoint the client as an agent to procure the asset or the goods. And the reason why the bank does that is because there is a risk that once the bank has bought the goods, the client can turn around and say, look here, these goods don't meet my requirements, my specs, whatever specification the client is giving to you. You might say that the particular asset falls short of those requirements. So in order to manage that risk, the bank appoints the client to go and identify the goods, negotiate the terms of the transaction, buy the goods from the supplier on behalf of the bank, and the bank makes payment directly to the supplier. And once the bank has bought the goods, the second requirement is that the bank must take delivery of the goods. And the reason why it's critical is because in Islamic law, there is this principle that is based on the hadith of the Prophet ﷺ, that you cannot sell that which you do not possess, or you cannot sell that which you do not own, and you cannot sell that which you do not possess. So there's a requirement that the bank must take delivery of the goods, and also this requirement also ensures that the bank has exposure to the associated business risk. So if, let's say, for example, once the bank has bought the goods and the goods now belong to the bank and the bank has taken delivery of the goods, and for whatever reason those goods perish, the risk will reside with the bank. In other words, the bank will basically take the loss. So there's a requirement that the bank must take delivery of the goods before the bank can sell those goods to the client. So there are two ways the bank can take delivery. One is physical, right, where possible, and the other one is constructively. So physically, it's not normally the norm, and the reason being that if, let's say, the goods are bought from somewhere in the country, right, and those goods have to be transported from wherever to the bank, and then from the bank to the client, then there's an increase in transaction costs, and those costs will be built onto the pricing, and then it will make Islamic financial products uncompetitive. So what happens generally is that if delivery is physical, then the goods will be delivered to the client, and the client will take delivery of the goods on behalf of the bank, and will retain the goods as an agent of the bank. So if anything happens in between the time when the client takes delivery and the bank sells the good to the client, the risk will be the bank's risk, unless the client is found to be, guilty of misconduct or negligence, right? Or delivery can be constructive. So in the case of the one example you have here, the case of a car, so the way constructive possession works is that the car is identified in terms of, let's say, the engine number. So the bank knows exactly which car it bought from the dealer, and the dealer will set aside that car for the bank to come and collect at any given point in time. And between the time the bank bought the car from the dealer and the time the bank collects the car from the dealer, if anything happens to that car, the risk is the bank's risk. The bank will basically, absorb the loss. So those are the two, mechanisms of taking delivery in a way that reduces, risks and also reduces, transaction costs so that the bank's products are competitive. So once the bank has taken delivery of the goods, whether constructively or physically, the bank then has the right to sell those goods to the supplier, to the client, and then deliver those goods to the client. So if the client has already taken delivery of the goods in his capacity as an agent of the bank, then the bank will issue a release note to the client so that now the client is holding the goods in his capacity as the buyer. If the goods are sitting with the supplier, then the bank would issue a release note allowing the client to go and collect the goods from the supplier. So this example, basically, it talks to the same principles that I was explaining earlier, that the client will come in and make an application, and then if the application is successful, the bank will issue an approval letter, and then the bank will appoint the client as an agent. And then at that stage, the client is then required to make, the promise to purchase the goods once the bank has bought the goods from the market. And the reason why the client is required to make an undertaking to purchase the goods from the bank once the bank has bought the goods from the supplier is because the bank is basically not in the business of buying, and buying the client. The bank normally doesn't buy goods and store them, right? The bank only buy goods when a particular client wants that particular, asset, or when the client wants a specific asset, wants those goods, and the bank will buy and then sell those goods to that specific client. Now, if the client turns around and says that now I don't want the goods, I don't need the goods anymore, the bank will have to dispose of those assets. Will have to dispose quickly of those assets in the open market. And if the net proceeds of the disposal of that asset is less than what the bank paid to acquire those goods from the supplier, then the bank will be sitting in a loss position. On the basis of this undertaking, the bank then will have the right to claim damages from the client. So if for example, the bank bought the car for 500,000 and the car fetches 450,000 in the open market, then the client will have to compensate the bank for the difference. In this case, it will be 50,000 rand, and that would be the out-of-pocket loss that the bank would have suffered in this particular case. So, and once the bank has basically bought or acquired the motor vehicle from the market or from the dealership, and once the bank has bought the car, taken delivery, then the bank will sell the car to the client at cost plus, and thereafter the client will be required to pay the purchase price in installments over the pre-agreed, finance term, or the client could, pay a lump sum at a future date. So basically that's about it as far as how Murabaha works. And this particular structure, it works for almost just about anything. It can be trade goods, can be motor vehicle, can be equipment, can be any durable asset can be financed in this way. So in summary, earlier on at the beginning, I said that I was going to basically touch on the economic benefits of Islamic modes of finance. And the reason why I spent a lot of time kind of explaining this when I was talking about the Islamic concept of money and the principle that the only way to make money in Islam is by investing in the real sector, is because sometimes it's not very clear what the difference is between Islamic finance and conventional finance when you look at it at an individual level, right? But when you look at the function of Islamic banks in the Islamic economy and the benefit of this way of providing finance to the economy, that way of financing the economy or providing finance in the economy, and then you see how significant the difference is. So as I've already indicated, that in the case of Islamic finance, capital is directed for towards the most productive real assets, which is not always the case in the case of conventional finance. The fact that Islamic finance is asset-based, basically it ensures that it ensures expansion of the real sector of the economy, and also it ensures that the economic growth is sustainable, right? Islamic finance also prevents the prevalence of toxic assets in the financial sector and the economic cycles of boom and bust. So in the case of conventional finance, you'll see that, to some extent, Islamic finance promotes, the prevalence of highly speculative, financial, investments, which often lead to asset bubbles, inflationary spiral, financial and economic crisis, wealth destruction, and recession and suffering. And we now at a stage where we basically witnessing some of the consequences of the interest-based, economic kind of system. And we see now that reserve banks globally, are trying to find, some way of, dealing with inflation. But whichever way you look at it, the outcome will be the same. It basically it leads to recession. It leads to, people, losing jobs. With the increase in interest rates in order to tame inflation, people are not able to pay or to service those loans that they've taken from banks when the interest rates were lower. Now they're in a situation now where they cannot, where they might actually lose those assets. So it's not a sustainable way of running an economy. And we also saying that this asset-based finance ensures that when the rich gets richer, the poor become better off. And how? Because it basically creates jobs. It creates jobs which result in income disparity and to some extent elimination of poverty. On the flip side, the interest-based system basically induces over-indebtedness. It basically leads to a situation where people find it impossible to come out of debt. And then we see corporate failure everywhere, and we also see economic stagnation. And we also said that the prohibition of interest allows for the poor to catch up. Why? Because for the rich to get richer, they have to invest the money and create jobs and whatever. Whereas the rich in the conventional system, which is interest-based, can get richer simply by lending money and live off the interest income, and they can remain rich forever just living off interest. Okay, so that's about it from my side. I'll stop there and take questions if any.
Jazakumullah khairan to Maulana Musa for that in-depth discussion and presentation. If we have any questions from the online participants and those here on the floor, you can feel free to raise those questions now. It has been quite a comprehensive presentation, so I think many of the questions that were noted down have been answered. But if there are any, we'll take them now. Everyone seems to be quite satisfied, and we are not getting any questions. So with that, I'd like to thank both our presenters, Reyaz Karodia and Maulana Musa Zuma, for availing themselves on the Saturday morning and giving us a good insight into how Murabaha Trade Finance works. And the recording will be available online for others to benefit. So please feel free to share it from our YouTube channel with your friends and family. And we look forward to hearing your feedback on the presentation this morning. With that being said, we will be closing the live streaming now. Jazakumullah khairan to all who participated. Assalamu alaikum wa rahmatullahi.